Yeah, so back in around summer, autumn of 2018, I turned pretty bullish on gold and silver, and so we added the gold, the silver, and some of the miners as well. And so over that time, those have done very well. Whenever we get these kind of pullbacks in precious metals, I'm still quite bullish when I look out with a 3 to 5 year view, and that's an example of something that even if it were to fall 10-20%, I'm a buyer of that dip because I still think the fundamentals look pretty good. Normally in a recession, you see a private sector deleveraging and a public sector increasing their leverage, right? And so this cycle's been quite odd because we haven't really seen a lot of deleveraging. We've had a very compressed time frame, but we've still seen, of course, the massive explosion in public leverage. And so we've seen a sharp a rebound in a lot of asset prices, but we still going forward, we still have a credit cycle playing out. So we still have many weaker companies going bankrupt or being impaired, and that's going to take probably all of 2021 to sort out. And over going back to 2016, it depends on what time frame you look at. So we saw when the dollar became strong in late 2014, early 2015, that caused a kind of a slowing growth worldwide, especially in emerging markets and especially their commodities demand. And so that's where we kind of saw a pretty big pullback, especially in the natural resources sector. And then since then, when we had a weaker dollar, throughout 2017, we had a global rebound and more liquidity conditions, and but that rolled over in mid 2018, and so we re-entered a strong dollar environment. We started to get slowing global growth, declining GDP growth rates, and of course that came into a climax this year when we also got hit by the pandemic. Yeah, so back in around summer, autumn of 2018, I turned pretty bullish on gold and silver, and so we added the gold, the silver, and some of the miners as well. And so over that time, those have done very well. And we're kind of currently in a consolidation, right? Because we at the last month or so, the prices went up pretty fast, pretty quickly. And so in some ways, they kind of reached overbought conditions in the near term. So I wasn't surprised to see a pullback. And I don't know if that pullback's over. I think I always kind of say it depends what happens with fiscal, right? So if you have kind of a more deflationary shock, people often think that gold is going to protect them in kind of all conditions, but it really kind of, so as kind of an insurance, it protects in all conditions pretty much. However, the paper price of it can fluctuate and go down briefly during big liquidity shocks. I think the catalyst I'm most heavily focusing on is commodity scarcity. And the reason for that is, it's hard to get broad inflation if commodity prices are low. And so if you look at energy prices, or industrial commodity prices, many of them are at the same price they were 10 or 15 years ago in dollar terms. Basically, we had that period of oversupply. And so, a lot of those commodities have just been very cheap. And that's, it's shown up the most in the energy sector. And we're starting to see some breakouts in some of the metals. Now, precious metals were the only ones that really kind of, went against that trend because they're generally the first to move. Whereas those broader, building blocks into the economy, those industrial commodities and energy, they've been very cheap. So if you look what happened in March, for example, we had that big deflationary shock. We had a decline in the gold price. And it was interesting because there was a big divergence between the price of physical gold and silver and the price of ETFs and futures and other kind of more paper products. So if you were trying to buy gold and silver during that sell-off physically, you couldn't really find it in most places. And if you could, it was way higher. So actually physical kind of coins went up in price, even though if you're looking at the ETFs or the futures, it took a pretty big dip, especially silver. It was actually a really good buying opportunity. And the other snare would just be that, soft yield curve control. So the Fed's buying a lot of treasuries, the treasury market just doesn't keep going higher, and then you get an inflation spike and the treasury market doesn't keep up. And then that'd kind of like the 70s snare, because there was no yield curve control in the 70s, and yet you still had those spikes to negative real yield. So either of those two options can occur in order to get a big blow off top and a big kind of sharp, upwards valuation in gold and silver. So I think, in many ways, they've already been doing soft yield curve control, which is why we're at negative 1% or so. And so the fact that the Federal Reserve has been the biggest buyer of treasuries in many ways makes them kind of doing de facto yield curve control. And if you look at different measures, like where the 10-year yield should be at this point, if you look at, for example, compared to the, it historically follows the copper to gold ratio pretty closely. Or, I mean, normally the 10-year treasury is higher than the inflation rate. And so this has actually been a pretty usual period where it's actually very low. It's at -1%, the real yield. And so they're already doing soft yield curve control. The question is whether or not they'll be able to keep doing that while you get an inflation spike. And so, whether or not they do it formally or it just kind of happens kind of more organically, those are the environments that would be very, very good for, commodities in general, but especially the monetary type.
So
I wouldn't be surprised to see kind of consolidation or pullbacks in some of the precious metals temporarily. And I would view that as another buying opportunity. I think physical is great to hold where possible. There's also kind of funds and miners you can get to get exposure. Longer term, I think that likely gold and silver are still kind of going to do pretty well because, I don't see this expansion of the monetary base kind of ending anytime soon. I think they're going to probably run very large deficits. A lot of it will be monetized, and we're probably going to have negative real rates for a while. So gold tends to be very correlated with, kind of inflation-adjusted interest rates. And I think that because we're probably going to have long stretches of those being negative, I think gold can do very well. But I think that there could be kind of pullbacks and more deflationary shocks along the way. So as you get a currency devaluation, silver can get a bid. And then as well as for its variety of, industrial uses, a lot, solar panels, electric vehicles, electronics more broadly. And so I think that's one of the metals that has a well-known, kind of long-term supply-demand favorable situation. Same thing with copper, same thing with uranium, same thing with, a lot of these key ingredients for future as we, diversify our energy mix and get more and more kind of electricity-based power. So having more and more kind of a grid, stronger grids, like, you need copper. And as we get kind of electrical vehicles continue to, slowly take market share. That'd be specifically on the monetary metals because commodities. So the one difference there is that commodities will tend to track inflation, period. And so if you get higher inflation, that should be good for things like copper, oil, silver to some extent. Silver can hold up a little bit better in that environment. It's a little bit of a mix of industrial and monetary. So higher broad inflation should be good for commodities broadly. Of course, unless there's one commodity in particular that has some sort of oversupply or something. But in a broad sense, that should be good for commodities. I hold silver directly, so it's one of the metals you can hold in physical possession or in vaults. There's also some physical ETFs or closed-end funds that can hold it. So I like direct holding, and then as well as I do also like to have some leverage with the miners as well. And I've incorporated both ETFs and individual names. Now, because I take a pretty top-down approach, I don't go deep into individual miners too heavily. So there's a handful that I track, but there are certainly specialists in the field that cover silver miners with far more kind of individual rigor than I do. Whereas, when I go deep into companies, it tends to be in other sectors because the mining sectors, it's very specialist. Whenever we get these kind of pullbacks in precious metals, I'm still quite bullish when I look out with a 3 to 5 year view. And that's an example of something that even if it were to fall 10, 20%, I'm a buyer of that dip because I still think the fundamentals look pretty good. I think that's kind of a key reason to have a process or kind of a base that you come back to see, instead of just looking at price, you're looking at price relative to certain models that you use, for companies that, that can include their earnings, their cash flow, their balance sheet strength, their historical valuation metrics, and, whereas for commodities or precious metals, you need some other tactics, but it still, ultimately comes back to fundamentals. Normally in a recession, you see a private sector deleveraging and a public sector increasing their leverage, right? The paper price of it can fluctuate and go down briefly during big liquidity shocks. The 10-year treasury is higher than the inflation rate. That'd be specifically on the monetary metals because commodities. So the one difference there is that commodities will tend to track inflation, period.